Thanks for your company. My name is Jessica, EMEA market strategist here with Moomoo. It's great to see you on the 17th day of December. So stocks are mostly lower on Wall Street. Globally, they were lower as well yesterday. And this is because we've got end-of-year rebalancing taking place. And this time it's pressuring stocks lower. So overnight, we saw the NASDAQ 100 fall ever so slightly. It's now down almost 2% from its record all-time high. The pin-up index that we speak about a lot, though, the NASDAQ 100, that saw a bit of dip buying, which is why the NASDAQ 100 edged up about 0.2%. But the big story overnight is that oil stocks are being smashed. We spoke about why this might be the case yesterday, and indeed that transpired overnight. So we saw the oil price fall about 3%. It's now at $55.14 a barrel. That's great for consumers. Means we're going to be paying less for petrol at the bowser, but it's not good for those of you who own oil stocks. That's exactly why we saw oil stocks really in sell down mode. So the thing is, we've got oil prices now the lowest since 2021. The concern is that we're going to have a weak year for oil next year because we've got oversupply, and overnight we've got fading geopolitical concerns. Last but not least, oil producers are really ramping up with their drill, baby drill. They're going to keep on pumping oil out, and that's exactly why oil stocks dominated the selling. So Phillips 66 down 7%, Marathon Petroleum, Halliburton, Baker Hughes, ConocoPhillips, you name it, all in the red. Aussie stocks expected to follow suit, and globally as well. No surprises there. But we are seeing some stability in other stocks or other assets. So you would expect gold to perhaps see a bit of stability. And that's because they've had, I guess, we've had some stability in the bullion price after it's had a 5-day rally. So let's take a breath. 2026, we're observing bullishness in growth assets, but the narrative is we're going to probably have a very, very bumpy year ahead. Here are 6 things that you need to consider and watch out for, covering key sectors and stocks. The first thing is that we've got some unfavorable economic news coming out. We saw that exactly transpire in the US overnight. So we saw US jobs weaker than expected. Unemployment rising more than expected. Unemployment now up to 4.6%. That's the highest jobless rate in the US since September 2021. Not very good news on the consumer front as well. Consumers are spending less. In fact, they basically didn't spend at all in comparison to the prior month. And that's what the retail spending sales came out with, showing retail trade in the US in October did not grow despite the market expecting an increase in spending. Essentially, all of this strengthens the narrative for the Federal Reserve to cut rates next year. And this is why bond yields fell. Falling bond yields, in theory, is good for stocks, but we have to consider why the market didn't move and why we actually, all in all, fell lower. Markets are being pressured. That's because the market is only expecting just one Fed cut next year. So you need to consider, staying on this first consideration here about volatility picking up in markets, consider this: each time we get weaker US economic data, you can expect markets to be pretty bumpy, unless, of course, the Fed's narrative changes and we are potentially going to start to see commentary come out about 2 potential cuts. Now, second consideration is, as economic growth slows, the world basically needs fewer employees to keep the cogs turning. Particularly, that's the case for the US, where AI is being really heavily integrated. So investors really need to consider who on earth this benefits the most from an increase in productivity. They need to have less employees. Basically, who's going to see higher profits and earnings as a result. So the market right now, as we stand, believes in the US, the NASDAQ 100 will be the biggest beneficiary of this. So earnings growth have been upgraded for the NASDAQ 100 companies. The market is expecting 18% earnings growth next year and the year after that. That's great. That's great if you want to be invested in the NASDAQ over the long term, right? The third consideration is for Aussies. Guess what? Australia's mining sector is actually expected to outperform the US. So we're looking at earnings growth in the mining sector in the ASX 200 is expected to see 28% earnings growth. We haven't seen this for a long time. I can remember the last time I saw this. So this basically highlights Australia's material sector, gold players, copper, aluminum. If you call it aluminum, I'll call it aluminium, nickel, silver. All these companies are expected to be increasingly heavily tied to the AI trade. So you should be keeping your eye on Aussie stocks. But not all Aussie stocks are equal. Oil stocks are obviously expected to see a sharp fall in earnings growth, obviously because we've been painting out the narrative that we're going to have oversupply, less oil prices, less profits for oil companies. In fact, earnings are expected to decline for oil companies. That's a consideration for you. Fourth consideration is sophisticated investors are actually very bullish on the years ahead. Overnight, Bank of America's fund manager survey basically came out showing investors are the most bullish they've been in the past 3.5 years. That's something for you to consider. But the fifth consideration is markets, of course, they don't look particularly attractive. They are on the nose, and I mentioned this at the outset, the fact that we do have the NASDAQ 100 and the S&P 500 trading lower off their highs. So I guess basically we need to consider traders and investors. They're getting two different sets of returns. Traders are perhaps achieving better returns in the choppy market. What are they doing? Traders are actually buying into the pullback of the S&P 500, the NASDAQ 100, and the Aussie share market. They're buying into the pullbacks and they're selling after the rallies. So that's a consideration. While investors have still actually benefited from long, steady returns throughout the year. And what I mean by that is think about what all three of these key indexes have done. The NASDAQ 100, it's up 19%, the S&P 500 up 15%. And our Aussie battler, the Aussie share market, hasn't done too bad this year. It's actually up 13%. Now, basically, all this highlights is you really need to focus on your comfortability factor. Are you going to be a trader or an investor? Whatever there is, there are some gains to be had, but it's probably going to be a very bumpy run ahead. We also need to consider that the final consideration is AI bubbles are still there. Particularly, this is ruminating from the NASDAQ 100, where momentum has faded. The fact that we've got the NASDAQ 100 down 4% is basically screaming that there are some concerns. But on the other side, you've got to consider, hey, we've got pretty thin trading next week. Only a couple days left till we close off the year and say, yay, Happy New Year. Basically, this means we could maybe, just maybe, have a Santa rally. And you could maybe see stocks charge up, but I'm not really sure of that. The sixth consideration is that when I'm going back to this AI bubble concern, is that we are seeing cash flows in the US among those AI players really dwindle down, all but NVIDIA. So balance sheets across the big AI firms, they are expected to remain solid, but there's a growing divergence between what next year could look like. Some hyperscalers are expected to be bleeding cash flow. Now, this is the concern about the longevity of the AI rally. Basically, we're saying, yeah, there are still concerns of an AI bubble. All major tech giants, they've all seen 12-month cash flows. You know, they're all everything's up and down. Nothing's in a straight line except NVIDIA that has been going up. It's not in a straight line, though, to be clear. NVIDIA's cash flows are still expected to dominate next year, but who is expected to really rule the roost and come up in hot pursuit is Amazon. Amazon is projected to see a surge in free cash flow benefiting shareholders. Apple also expected to see really significantly strong free cash flows also for the benefit of shareholders. But market estimates are, I guess, now flashing warning signs. Meta and Microsoft could see cash flows come under pressure, serious pressure alongside Oracle. So that's something for you to consider. Now, the takeaway from all of this, ladies and gents, is that you probably want to be stock specific. Potentially look at maybe even buying into pullbacks and selling after rallies, or alternatively, if you want to take a set and forget relaxed approach, you maybe want to take a very long-term approach when it comes to investing, but do expect a volatile year as the market really navigates growth concerns. Now, let's move to some stocks to add to your watch list. Let's kick off with Amazon. as we just said, they're expected to see a surge in substantial free cash flows next year. For 2026, what does it look like? Well, the market's actually telling us cash flows could be in excess of $100 billion US. Just extraordinary. Now, all this is driven by the huge demand for Amazon's AWS, and also they are investing heavily into AI, and they're expected to see a strong return on this investment from advertising, improved fulfillment, efficiency, and all in all, basically higher profit margins as a result. And higher earnings growth, cash flow growth, earnings growth drives share price growth. That's the thinking. And this is exactly what the market is suggesting, and that's consensus. Our free cash flow in the years ahead is expected to get to 140 billion in 2029. So that's something for you to consider. But look, the stock, all in all, across the year, it's not really done much, has it? But analysts, if you do have a look at the consensus, we are seeing potentially 10 to 30% upside next year, depending on what analyst price target you look at. Now, let's move to oil stocks. One of those on the nose last night was Marathon Petroleum, falling almost 5% amid the demise of the oil sector's sell-off. So who is Marathon Petroleum? Well, for those who've been following, they operate some of the largest refineries in the US. They have, however, done really well in comparison to their peers. They're up 30% this year and are up a massive 353% over 5 years. If you have a look, their earnings are expected to actually increase as well. Expected Q4 earnings of $4.03 per share. That's actually a significant jump compared to the same time last year. It's a jump of over 400%. Recently, I guess shareholders did like the fact that they entered into a deal to co-develop submersible robots for the use on their oil terminals. So that's really interesting to see how that transpires. But nevertheless, the fact that it's got a buy rating really suggests that the thinking is that analysts are still quite bullish on this stock, despite whatever happens to the oil price. But do keep your eye on Marathon. Let's have a look at another one. Treasury Wines, Down Under. This one is worth a tipple. So Treasury Wine this morning came out basically saying that they expect a downturn in demand in the US and China. And of course, as we know, this is really significant because Treasury Wine has previously marked both of these regions as their key growth areas. So really watch Treasury Wine. So they also revised their first half-year earnings down to 230 million. The market's probably not going to like that, and they're cutting their distribution. So also interesting to see shareholders, they might not like that as well. Of course, no one likes their lunch being cut, but they are overtaking and I guess you could call it a global undertaking or an overhaul, looking to save $100 million. Let's wait and see how they're going to do this. But as we stand right now, the market is still quite optimistic on the stock, and this is reflected by the fact that it's got a buy rating. But Citi this week earlier came out saying it's a sell. Really interesting to see how this transpires. Do stay safe, happy trading, and we'll see you tomorrow.